I've seen people lose tens of thousands, hundreds of thousands, and even millions of dollars with whole life insurance because they made a mistake. And the thing is, the mistake they made was not their fault. The mistake was that they trusted the agent or advisor that they were working with. I'll share 3 quick stories. So we've got Mr. Dave, Dr. Doug, and Money Mike. Starting with Mr. Dave. He's a teacher who bought a whole life insurance policy from his friend, and he paid a little bit more than $10,000 per year into this policy, and he was interested in the cash value. The thing was, when he bought that policy, what do you think the cash value was right out of the gates? In the first and second year, his cash value was 0. All of Dave's payment went toward the insurance premium, and he had no cash value to show for it. He'll have to wait between 10 and 15 years just to get his money back. Next, we've got Dr. Doug, who's a doctor. Now, he was sold a policy where he paid $100,000 per year, and his first year cash value was also 0. It might have been 2 or 3 grand, but next to nothing. Now, the thing that was interesting about Doug the doctor is he bought a whole life insurance policy purely for cash value. He decided to put that much into a policy after reading a book about infinite banking, and the agent sold him that policy, and Doug knew what a policy should look like. Like, he had an idea that he should have some cash value up front. You would know that after reading that book. However, the agent told him, well, before you see the cash value, you need to capitalize it. And Doug said, all right, well, I trust the agent, so it'll build up over time. And he had next to nothing to show in cash value up front. And then we've got Money Mike. So this is a young entrepreneur. He was in his mid-20s when he started a policy. And he paid $7.6 million per year. He was recommended to get a big whole life insurance policy by his estate planner. So the estate planner introduced Mike to an insurance agent that specialized in life insurance products for cash value, or apparently specialized in them. The problem was the first year cash value was not 0. It was around 1.5 million or something like that. I can't recall the exact number. The big problem with this, though, is that $7.6 million payment was all insurance premium, meaning he was locked into paying that every year. So he's in his mid-20s, does very well in business, but he doesn't feel that he's going to be able to pay that premium forever. When he started the policy, he did. Now he doesn't. Now he feels stuck, or if he decides to cash out the policy, have to take about a $10 to $11 million hit based on where he's at in the policy right now. So all of these mistakes are very costly. So how do you avoid them? That's the question. Well, with a whole life insurance policy, whether you're funding $10K per year or $1 million per year, it all has to do with how that policy is designed. Here's what so many people are not aware of. When you pay money into a policy, so here we've got you're ready to start your whole life insurance policy. Here is your money that you're going to pay into the policy, and you're interested in cash value. The thing is, you can actually decide where your money goes. A lot of people are not aware of that, meaning we can decide to direct it toward the cash value instead of the life insurance. To help make you aware, when you pay money into a life insurance policy, it can go toward one of 2 main areas. So here's your money going in. The first area it can go toward is your base premium. So any dollars you put toward your base premium with a traditional whole life insurance policy typically give you 0 in cash value in the first year, sometimes the first and second year. The reason why is because the company is going to overcharge for the cost of life insurance up front. Whereas money that you pay toward your PUA rider, which stands for paid up additions rider, guess what? In the first year, shows up in cash value. That's what I'm talking about. That's money that begins to compound. I can access it Putting money here is the key to accelerating the cash value growth of a life insurance policy. Now, when you pay money toward your PUA rider, it will also get you some death benefit, but it's very small compared to what the base premium gets you in life insurance. So if you focus just on the first year, where would you want to put your money? The base premium that gives you nothing in cash value, or the PUA rider, where you see the majority of your payment show up in cash value right away? The PUA rider. Now, as time passes, you will see that your base premium does credit the cash value. It does begin to compound. It's not a forever expense. I always like to mention that because you do have the word premium, which typically we just associate with the word cost because it's an insurance product. I get it. With that said, how do I get as much cash value as possible? Well, how do I avoid the mistakes that Doug, Dave, and Mike made? Well, it's being aware of how low I can set that base premium. If you look at some of the top life insurance companies, if you look at your 4 major mutuals, who are Mass Mutual, Guardian, New York Life, and Northwestern Mutual, in most cases, you can set your minimum premium to about 10%. What that means is whatever your total payment is, so if this is you and you said, hey, I'm a lot like Dave, I want to put 10 grand per year into a life insurance policy, that's the most I ever want to pay in, well then I know, based on the rules of the game, I can put 10% of that, or $1,000, toward my base premium, and the other 90% toward my PUA rider. And now all of a sudden, instead of having 0 in cash value in the first year, I'm going to have somewhere between $8,000 and $9,000 in cash value in the first year. You won't see 100% of your PUA payment show up in cash value immediately. There are fees there. I also have to have a term insurance rider attached to prevent what is called an MEC or MEC, which is a taxable event with a life insurance policy. My point is, if we reduce the base premium and put more money toward our PUA rider, we're going to see more in cash value. Let's take a look at an example. So here is a life insurance product with the same company and the same out-of-pocket for this individual, but just a different setup. So we're going to look at someone funding $20,000 per year, and here we go. So with policy A, what do you see? Year 1, you pay in $20,000. You've got about $1,700 in cash value. What's highlighted in yellow represents what I call the break-even point, meaning at year 13, he has paid a total of $260,000 into this policy, and he finally has a little bit more than what he's paid in. He's got $263,000. If you go a year backwards to year 12, he's paid a total of $240,000, and he has $232,000. So he has less in cash value than what he paid into the product. So why this example looks so bad is because all of this payment, this $20,000, is directed toward the base premium and nothing is going toward the PUA. Next, we've got policy B. Same insurance company, same product, different setup. What do you notice about the first year cash value? About $10,000 right out of the gates. What about the section highlighted in yellow? Now it's between years 10 and 11 instead of year 13. Much earlier. And if you look at year 20, you've got more cash value as well. The difference between this policy and the first is that this one, policy B, has 50% of the total payment directed toward the base premium, and the other 50% is directed toward the PUA rider. So $10K toward each. And then we've got the last example, policy C, and what do you notice here? Well, first year cash value, just about $17,000, which would be 85% of what he paid into the policy is immediately available. It breaks even at just about year 5, and he's positive in year 6 in this particular example. If you look at year 20, which option gives you the most cash value? Policy C. And what's so interesting about this to so many people is that you have the same insurance company, the same insurance product, the same out-of-pocket to them, but it's just set up differently. It has to do with where your base premium and a PUA rider is going. This one, you've got your base premium at $2,000. That's the key. Whereas the others are at $10,000 and then $20,000. So why isn't everyone shown policy C? Well, it's either A, because the agent does not know how. I will say that it takes time to learn the software and understand how to design a policy like this, depending on the insurance company. Some insurance companies allow simple solves where you just click a button. Others, it's going to require an investment of time. But one, I do have to have the knowledge on how to set up a policy properly. But then two, I also have to be willing. So what this means is that I have to be willing to take a lower commission to show a policy like this. So if we look at the commissions down at the bottom, this displays just the first year commission, meaning renewals are not included in this example. And what do you notice? It's a big difference, isn't it? The takeaway here is that if you're looking at a whole life insurance policy, know that the lower the upfront cash value is, especially in that first year, that's the key. The lower that first year cash value is, the higher the agent commission is. Exact same product, exact same commission rates in this particular example, but by redirecting where the money's going and beefing up the cash value for the policyholder, the agent does end up making less. So that's something that's good to be aware of. You could also ask your agent, hey, what is the commission on the policy you're recommending to me? And can you show me what the commission would look like with a 1090 design, meaning a minimum premium design? I know that can be difficult for some to ask, but just remember, it is your money going into the product. Anyway, the point is, what I would aim for is when you're getting a whole life insurance policy for cash value, know what the minimum base premium is with the insurance company that you're considering, and then ask to see an example with that premium minimized. If you're looking at the 4 major mutuals, a lot of times it's right around 10%. I'll close with this. Your 4 major mutuals are Mass Mutual, Guardian, New York Life, and Northwestern Mutual. If I give you 2 of them, starting with Mass Mutual, as a company, wherever I set my base premium, say it's $1,000, they recently updated their limits. They'll allow you to pay 15x the base premium in PUAs. It's $15,000 there. That's Mass. If you look at Guardian, another one of the 4 major mutuals, if you set the base premium at the same $1,000, they'll allow us to illustrate 10x the base premium per year, which is another 10K, as long as the term rider is attached. In the first year, they actually allow us to go as high as 50x, which is great for lump sum deposits if I want to kickstart a policy. And they also offer a lot of flexibility where you can set it up where you're just billed for the minimum premium, and then you can add PUAs over the course of the year whenever you want. If you don't hit 10x, that's okay. You can make up for lost time. My point is, different companies have different rules. I hope you enjoyed this video. I do hope that it helps you avoid a costly mistake with whole life insurance in the future. And as always, I hope this helps.